Well, hello, everybody, and happy Tuesday, May 24th already. We are almost into June gloom. It certainly felt like it here in Southern California. My name is Stephen Meade with Domicile real estate for people who love houses. And this is our Southern California housing market update. And I want to talk a little bit about something. And, we started doing these videos. If you've been watching for a while, we actually started these right after the lockdowns began. And part of it was I had a lot of clients asking me and wanting information and wanting certainty and wanting to understand what was happening in the market because, obviously these were sort of crazy times, right? In that period in March of 2020. And people didn't really know what was going to happen. And it was hard to read market conditions and really get a bearing and get that sort of 30,000 foot view. And I actually think we're a bit back to that situation. And before we jump in to these stats, I asked the question, are you confused yet? And part of the reason being is, as human beings, we like to distill our information down to easy decisions, right? The Fed raises rate, that means in mortgage interest rates went up. By the way, that's not true. It sounds good, right? And it sounds intuitive. But a lot of these systems are much more complicated, and that's why they're difficult to predict. And these models of behavior in the market are not dependent upon a single variable. They never have, and I don't think they ever will be. So, right now, you might be hearing the sound of screeching brakes. And I'm not going to lie to you. I think we're seeing an incredibly uneven and almost bizarre acting market. It's an almost unstable feeling market, right? Like where you feel like the weather is changing and we don't know whether it's a storm coming in or it's just a 15-minute squall or is it going to rain all afternoon, right? And this reminds me a lot of how things felt, March and early April 2020. And, I remember my prediction at the time was that those first 30 days were going to be pretty crazy and then things would stabilize out. People would start to understand that the sky wasn't falling. And, that's exactly what bore out, right? We actually saw prices decline about 5% in that first 30 days from the lockdowns, and then they stabilized and then they started moving upwards. And, when I look at the market now, if we hit a little bit of an affordability breaking point to some degree, I think we have, but I wanted to pull up an interesting graph because I know a lot of agents are using this statistic. It's out there from Fannie Mae. It's kind of an interesting one. Let me pull this up here. So this is a graph here that Fannie Mae has put out. Or I think that, right, and not Fannie Mae didn't put this graph out, but this shows Case-Shiller index on prices, and this shows Fannie Mae's prediction for 2022. Now, Fannie Mae actually made this prediction right about a month ago. So this is still a fair recent prediction where they say 10.8% home price growth for the year 2022. Now, what this graph doesn't tell you, it does tell you that they are predicting 3.2% for December 2023. What they're not telling you, right, is that the first couple months of 2022 probably got close to a 10% gain in prices, meaning, we've largely already seen that gain that we're going to get for this year. And I do believe we're going to see some kind of stabilization or small gains through the rest of the year. I think that's where we're going to sort of settle out. Right. And by settle out, here's what I mean by that. When we talk about a 12% of your home gain, and I love illustrating this point, in our minds, we think that means home prices go up 1% a year, just like this, right? And that is not at all what happens, ever, really. And we've gotten a lot of our gains already for this year. And what I think we're going to see in this market is we've got people really taking a pause, I think, in this week. And I think this is going to probably persist for the next few weeks. I think we've really got people sort of adjusting to this new landscape. And then I think things are going to stabilize out. And the reason why I think that is we're already seeing something that I call a reactive market. And I'm going to go and tell you that. Remember, maybe about a minute ago, I mentioned something about these markets are dependent upon multiple variables. And there's no single variable that sort of tells you what a market's going to do. But combined with a couple of things that I'm seeing on there, my inclination is to believe that we're looking at stability that's going to come in probably in the next 30 to 60 days. And we're going to have a new market. And what we're seeing right now is this sort of transitory period where people don't really know what to think and don't know what to do. And they don't feel like they have a good bearing on what's happening. And, whenever consumers are in that situation, they tend to not act, right? Like they tend to delay and hesitate. So let's get into the actual numbers here, because I think that really is going to tell us what's going on. So first thing, active listings. This is our inventory in the market. It is up, right? There is no question that there is more inventory now than there was last year at this point in time. And I would even argue maybe we're at about the same total inventory level in our market as we were around middle to late August of last year. So I think that's a pretty fair assessment. So, in the grand scheme of things, is it a huge amount of inventory? No, but it's definitely a bit more inventory than we faced last year around this time. Okay, so inventory up, right? New listings. This one is very interesting to me because if you look at this graph, our new listings total, right, between these two price categories, both our under 1 million and our 1 to 2 million, our total new listing activity is about the same as it was last year, and maybe even a little bit less. That is very important to understand. One of the things that I've talked about in the past is that consumers, whether you're a buyer or a seller, you don't live in a vacuum, right? You all will make your decisions based on present market conditions, meaning if there are more buyers in a market, that will influence how many sellers you have and vice versa. There is some, relatability to these variables. There's a sense of covariance to these variables. So you have to understand that none of these things exist in a vacuum. So our level of listings coming onto the market is the same or maybe a little bit worse. Now, our level of new escrows, right? This is the one that's really kind of gone down. And I'd say it's probably gone down about 20%. And this is why you're seeing inventory rise. And where we're really seeing this is in that under 1 million market. But the reality is we're seeing it a little bit in the second one. Remember, we talked about price creep actually means that these ranges don't mean what they meant last year. Now, the real one here is if you look at this absorption rate, right? This absolutely says that the rate of people buying versus the rate of homes coming on the market has declined, right? And it's declined a lot in that $1 to $2 million category. We are now in the low 60%. That is more of an even market, meaning those homes between $1 and $2 million are facing more of an even market between buyers and sellers, right? We're still above 70% here for under 1 million. So I'd still say under 1 million is still a seller's market, but not a heavily tilted one. Now, if you look at our closed prices, we saw kind of some dips and then a little bit of a rebound. Remember, this stuff is 4 to 6 weeks old. Pretty strong at that bottom end, still pretty strong in the median, and it's that upper 75th percentile that looked a little soft. Now, if you look at this is kind of an alternative tool that we use called the percent still active after 14 days on the market. And this kind of tells you, right, which listings are the ones that are lingering. And you know what, honestly, these numbers are high, but they are really on par with sort of where we were maybe about in the middle or end of August of last year. These are not terrible looking numbers. And while they rose quite a bit through April, they're starting to stabilize out. And to me, that's another indication, right, that the market we are seeing today is a market that's kind of going through sort of that transitory period, but it's going to settle somewhere. And we're seeing a lot of consumer behavior that's based on hesitation due to uncertainty. This one is kind of puzzling to me, right? Is that we're looking at that close versus list ratio, and it stabilized out and it has not fallen as much as I would have thought. I do think that check is in the mail. I think we are going to see these numbers start to come down towards 100% as we see a couple of greedy sellers just kind of end up, and maybe not even greedy sellers, but sellers just kind of indicating where they think the market should be or where they'd like it to be. And we might see that these numbers actually start to head back down to that 100% level. But this is the one that I think is especially interesting to me. And this tells you a lot. The days on market for new contracts. So what I like about this is that this is based on data that is less than 2 weeks old. So unlike sold data, which is old data, right? Sold data is old data. This is much more current data, and this is based on the homes that are actually going in escrow. So this isn't the whole market. This isn't days on market in the whole market. It's days on market for the houses actually finding buyers. These numbers are not going up. And what does that mean? It means that there's still this notion that if you have something people want, your marketing time will still be relatively short. And then we're taking a look at this chart. And this is the other one that leads me to believe we've got some stability heading our way, because we're seeing the markets find an equilibrium point. And equilibrium points are where you have stability in the market, right? So if you take one variable, in this case, we'll call it interest rates, and you change that variable relatively quickly, that market is going to need time to get some footing and adjust and find an equilibrium. And you might find that there's some breakage during that time period. And by breakage, I just mean there's consumers who are scared, who are uncertain, and they're hesitating. And I truly believe some of that stuff, or a lot of that, is going to settle out. And look at what we have here. So our blue line, again, is our payment index. Where are we settling? We have settled. That kind of jumped up here with rising interest rates. It's settling out, maybe even declining a little bit. But we're not seeing this drop in wholesale. It's just kind of found sort of the ceiling at about 58% or so of where the payments were in June of 2018. So what does that mean? In about 4 years, the payment on a median priced home has gone up 58%. Have wages done that? No. Has inflation done that? Not quite, but inflation is closing in on that 20% mark, right? So inflation is in fact going up. But the real big one for me is this rent index, right? The rent index has followed housing all along. Housing took a huge increase, right? But look what's happened. It took a little bit more time, but now rent has also gone up and found this sort of plateau that has really shrunk that differential. Of how much has the payment on a median priced home gone up versus how much has the median rent gone up for single family homes. Again, this is in LA and Orange counties, just as a reminder to everyone. And so when I see this looks like we are finding an equilibrium. And that's the reason why I think some of this kind of consumer turmoil and uncertainty, we're going to work our way out of that. We're going to end up with a market we're going to call our new normal, at least for the time being. And then if you look at our prevailing interest rates here on mortgages, something we don't show in this chart, this is based on our 30-year fixed rate national average. I'd really love to run this and add on here a 7-1 ARM option to show people how those rates move in relation to each other, that, those rates were probably largely the same all through here. And as the 30-year fixed rate went up, those 7-1 ARMs did not go up nearly as fast. And now there was a decent spread, right? So, what we're seeing is we have consumers that are obtaining mortgage rates in the 3s for adjustable rate mortgages. This is happening for our buyers. Over 50% of our buyers are getting adjustable rate mortgages right now. So, they're experiencing much less of an increase in actual payments than many other consumers. And I think a lot of consumers are actually taking that option. So what does this mean if you're somebody out here in the marketplace? Like, what does this mean if you're a seller? Well, if you're a seller, here's the good news. The good news is I do think we're seeing a market that is stabilizing. Give it another 30 days or so to kind of adjust and figure out its footing. With that said, this isn't a certainty, and other things could change. So if you're a seller sitting on the sidelines thinking, well, I want to wait until that market stabilizes, that might not happen. Something else could introduce. World War III could start, right? Russia could launch a nuclear weapon. Who knows how that would affect our markets? A lot of these things can happen. We have monkeypox. I mean, you read the news every day. We don't know which of these things could have a profound effect on our market. So, I always tell sellers, we can tell you what the outlook is today, but we can't tell you what the outlook is going to be tomorrow or a week from now, right? Like, these are our best guesses based on the information we have available today, but that information could change. If you're a buyer, it's kind of an interesting time, right? Because, if you're a buyer, I think you might be a little scared and you might be feeling like you don't have an idea of certainty or footing in this market. And, I think that's natural and that's okay. Again, similar advice to you is I think we are going to find a natural footing. But the one thing I've seen is I think if people are expecting this sort of market crash to happen, I'm already seeing this sort of equilibrium finding behavior. So I feel like if there was a crash that was going to happen, it would have happened. And it hasn't. So again, though, the caveat to this is based on the information we have available to us today, and things could change in these variables and they could cause sort of some differences. But I do know, we have a lot of things that are in favor of a stable market. The biggest in California being we just don't have enough houses. Like we have solved our acute inventory problem, which is we don't have enough houses for sale, but we haven't solved our overall inventory problem, which is we don't have enough houses for people to live in. That problem has not been solved, and I don't see the politicians really making a huge amount of headway on that problem anytime soon. And, maybe a couple of years ago, I would have told you, that problem will solve itself with people leaving California. The problem is when you look at the price growth in some of these other target markets where people were going, they no longer look like the deal they once were. The net result is that everywhere housing has gotten more expensive, both rental and for purchase housing. So, I still like our overall market indicators. And I think what's fascinating is if you go back to this graph here, if you asked a bunch of people, how do you think the market is going to reconcile rising interest rates? They would have told you prices are going to drop. And yet the reality is, look what's happened. Rents instead have moved up to address that disparity and narrow that gap. The market frequently surprises us by behaving in a way that overall is textbook correct, right? It's looking for an equilibrium. This disparity something has to happen with this disparity. But sort of like that genie who grants wishes literally, and it might not always be what you thought you were going to get. Our market as such also delivers results that are like that, where it is not what we thought we were going to get. So anyhow, I think that's all I've got for you on this Tuesday. If you're a buyer out there, I think there's some really good things for you ahead. You actually have choice in listings. I'm not telling you to buy that 0-bedroom, 3-bath house because that's where you got an offer accepted. I get to tell you to be strategic. Buy the home you think that is going to be worth something and have some unique attributes 20 years that consumers will want. We are in a higher inflation environment, and historically, higher inflation has always led to higher home prices in almost every case. So, history is on the side of there not being a crash as a result of inflation. But, anything can happen. I always tell people that. But, as a buyer, I think now's the time to get serious about what you actually want to buy and be strategic. You're not just buying to get into the market. You're buying to get something that you think is going to be a good long-term decision for you and for your finances. Anyhow, thanks so much for watching. Questions, comments, we love them. If you would like to access some of our expertise for your own real estate transaction in Southern California, absolutely reach out to us. We would love to work with you. Do not forget to like, subscribe, and hit that notification bell. And we will see you again real soon.